Hirlock, and I wish to thank the Ceann Comhairle for selecting this topic for debate. Minister, I welcome you here this afternoon. This is a hugely pressing issue on households in Ireland, and we've got to always convert what may be statistics and numbers into people. And the Minister across the way from me understands this better than anyone, because that's what politics is all about and fairness is all about. Roughly speaking, as Deputy Michael McGrath pointed out in his bill on the 31st of March and 1st of April regarding the standard variable rate for residential mortgages, that debate was very important because he was able to take the overview that AIB, for instance, which is a pillar bank, one of the duopoly of banks at the moment, AIB has 130,000 mortgages, PTSB about 80,000 and Bank of Ireland about 70,000. Now, in the case of AIB, they're charging on average for their variable rate mortgages 4.15%, and Bank of Ireland and permanent TSB on average 4.5%. The current Eurozone average for variable standard rate mortgages comparable is 2.5%. That is actually an extortionate rate, a shocking rate of nearly sort of 70% more than the Eurozone. And that's not right. And the banks cannot just decide to hold a duopoly hold over the nation in respect of loans that they advanced into a credit pyramid bubble that they created. And I have here, I won't have time to go to the figures, but I want them to go on the record, the calculable culpability of the two banks, in fact, of all the banks, by reference to their funding models, as they call them. And there's no such thing as a funding model. It's funding principles, because the principles of banks funding their assets is determined by bank boards. And unfortunately, in the banking inquiry across the way, this isn't actually even being addressed, which is a shocking indictment on the inquiry approach. The bank boards, by reference to their balance sheets, which is the evidence, the financial evidence of what the bank boards decided as policy over 7 years, 2001 to 2008, was a reckless departure from 90% loans to deposits to 173% weighted average. That is wrong. And it is wrong that people who have the legacy loans from that era are being forced to pay an extortionate super profit margin above the normal new loans margin. Today I took a walk around the three nearest bank branches. AIB on the Lower Grafton Street has an ad emblazoned above their door which says, Mortgage Awareness Day, Saturday the 21st of March 2015, 10 a.m. to 3 p.m. What an irony. By God, their 130,000 mortgage variable standard rate holders know about mortgage awareness. In the case of Bank of Ireland, a picture of a house. Need to move, the question asks. We pay your stamp duty to the value of 1% of your mortgage, which now is going to be only 80% of the cost of the house at most. So that's another illusion and another lie to tempt people innocently into what the Bank of Ireland says, for small steps, for big steps, for life. Yes, it was for life, with their 80,000 standard variable rate mortgages paying about 2% super profit over Eurozone rates for a Euro loan. It's just wrong, Minister. And you've got to take, particularly Bank of Ireland, to heel on this. They're out of control. And their board of directors, if you look at them now, they're down a man 9 months ago who made a $500 million profit from his small investment of 350 million, which was a one-way bet into profit. Back to America, he's gone, and the remaining directors, there's 12 of them. And do you know the interesting thing about them? The interesting thing is that the governor is British, and he's been mainly involved in the Lloyds Group. The next non-executive is Kent Atkinson, also British, Lloyds TSB. The next is Richie Boucher, who spent a lot of time in the Royal Bank of Scotland. And then you've got Pat Butler, who was in the Resolution Group and McKinsey. And then you've got Tom Considine, who was the Secretary-General of the Department of Finance, Advisory Committee to NAMA and board member of the Central Bank. You've got Patrick Harron, British, Northern Ireland Electricity, in the Invest Northern Ireland. Andrew Keating, Ulster Bank, and he's only a young man. You've got Patrick Kennedy, who was with McKinsey, so you've got common McKinseys there, and all the companies that they advise. Davida Marston, British. And my point is this, that they have no empathy or understanding, because those who aren't British, Canadian and so on, you've got two people who were in Zurich, and Zurich was where John Moran, who was the Secretary-General of the Department of Finance, Capital Markets. These are important things, because these are the men and women who decide the policy of the bank, who decide what variable rates will be, when they will move and when they will be changed. In the case of Bank of Ireland, they report a profit of 1.1 billion
Deputy, you have 2 minutes to respond after the Minister replies.
This is nationally important, and I understand the rules. A turnaround from a loss of 1.7 billion, which means a turnaround, from a loss of 1.7 billion in 2013 to a profit of 1.1 billion, a turnaround of 2.8 billion. And you know what, Minister? You know this as well as I. That's all to do with provision, manipulation of provisions. It's not to do with the health and the normal operating profit of the bank.
Thank you, Deputy. You have 2 minutes to reply after the Minister responds.
The same was the case of AIB. This is seriously wrong. It's something that we've got to be honest, courageous about, for the sake of Irish people, because 300,000 mortgages represents about 1 million people living in those houses.
Thank you, Deputy.
About that, and that needs to be addressed. Thank you.
Thank you, Deputy Mathews. 4 minutes, Minister.
I wish to thank the Deputy for raising this important issue. As the Deputy is aware, the Statement of Government Priorities 214 to 216 recognise the need for competition in the banking sector to put pressure on the banks operating in Ireland to reduce the interest rates charged. This issue was also discussed in the context of a private member's motion put forward in the House just before Easter. It has also been the subject of a number of recent parliamentary questions. I met with the Governor of the Central Bank on the 2nd of April last to discuss this issue. The Governor provided me with an update on the ongoing work that he and his officials are carrying out on the issue of the standard variable rates charged by the lenders. At this meeting, we spoke about the fact that SVR charged in Ireland are higher than in other euro area countries and have not fallen in line with ECB wholesale rates. The Central Bank will continue to research why this is the case and will publish results shortly. The Governor will update me on the progress in due course. As the Deputy will be aware, it is a commercial matter for each lending institution to determine the rate it charges its customers depending on a number of factors, such as cost of funds and commercial considerations, such as competition, risk pricing and the impact on deposit rates. However, the Government would expect that as the cost of funding for the banks reduces, that this will be reflected in the interest rates charged to both new and existing customers. As the Deputy will also be aware, the Central Bank has no statutory role in setting of interest rates by regulated entities, apart from the interest rate cap imposed on the credit union sector in accordance with the provisions of the Credit Union Act 1997 and the requirement to be notified of penalty or surcharge interest imposed in respect of arrears. Nonetheless, as I have said, the issue of regulation of interest rates remains a policy area under active review and has been the subject of recent correspondence between the Department of Finance and the Central Bank. The current position is that the Central Bank does not have new proposals for the additional regulation of interest rates. The Governor of the Central Bank, Patrick Noonan, in his opening statement to the Oireachtas Joint Committee on Finance, Public Expenditure and Reform last November, stated that in Ireland, as in most advanced economies, it has long been understood that tight administrative control over the rates charged by banks will be counterproductive in ensuring a sufficient flow of properly priced credit on a lasting basis. Such control would strongly discourage new entrants when, in fact, ongoing competition in the banking sector would be crucial in ensuring that the economy is provided with efficient and cost-effective banking services. In this regard, there has been some movement on mortgage interest rates of late by a number of institutions, which suggests that the market may be entering a new and more competitive phase. The Central Bank Supervision and Enforcement Act 2013 introduced changes to Section 149 of the Consumer Credit Act 1995, which regulates fees and charges in order to attract new entrants to the Irish banking sector. There is some evidence of improvements in the banking sector, with a number of institutions introducing new products and adapting their business model. In the last 12 months, there has been a number of new entrants to the Irish mortgage market, bringing additional and welcome competition to the sector. While not an option to all borrowers, those who are in a position to move mortgages should look into their options to do so. The banks must be convinced that they are at risk of losing customers if they persist with SVR rates higher than what is available to their customers in other banks. The Competition and Consumer Protection Commission website at consumerhelp.ie has useful information on the process. The website also contains comparisons of mortgage products and gives information on incentives that institutions will give to encourage switching. To conclude, as set out in the Statement of Priorities 214 to 216, supporting increased competition in the banking sector is essential to put downward pressure on interest rates. Increased competition between existing and new entrants will have the effect of reducing prices to consumers, which in the mortgage sector means reducing the SVR.
Thank you, Minister. Deputy, you have 2 minutes to respond.
Thank you very much. Just in case I got muddled there in my previous contribution, it's AIB reports profits this year of 1.1 billion against a loss of 1.7 billion for the previous year, a turnaround of 2.8. And Bank of Ireland, similarly, a profit 920 million 2014 and 0.5 billion loss 2013, a turnaround of 1.5 billion. So you've got two banks in a duopoly situation doing a turnaround of 4.3 billion against the reality, the human reality, as customers of the banks and as operationally completely insulted by the bank duopoly. And I've first-hand experience, Minister, of this. I'm serious about this. I'm a former banker, commercial banker in a state-sponsored bank, which was the bank to businesses, SME businesses, a worthy bank that understood the principles of banking and kept really close to their customers. That's not what's happening now. The banks are removed. My example of the board of Bank of Ireland, 4 people are completely foreign, and the rest of them, bar 2, have had all their working experience outside of Ireland. They are remote. They are unfeeling, and I don't mean they've to be sort of lovey-dovey feeling, but they are actually out of touch with the people who live in the households, work in jobs and work in businesses, in a sense of blood and heart. And it's not right. The last bank that I passed by was PTSB. Their ad reads today, ready to buy a house, ready to buy your first house, ? Yes, give me a debt, ! Permanent debts, TSB, back to basics. Do you know, that sort of philosophy, from if you like to call it that, from those 3 banks shouldn't be allowed, given what's happened. And the boards of banks, I'll give you the paper, I've sent it into the chairman of the banking inquiry, that shows you that it was bank boards and auditors clearly at fault, on evidence. You don't need this processional thing that's going on in there. Do you remember in May of last year when there was a proposal to have as a term of reference that every member of every board, 2001 to 2008, would be required to be in attendance at one place to listen to the reports, their own reports of their own accounts and their own financial engineering and lack of principles for those 8 years, with the auditors behind them, so that they could listen and let the people of Ireland see how a credit pyramid, which was out of control, where the domestic banking of Ireland grew from 3 times national income to over 5.5 times. That is so unacceptable, so wrong, and nobody has said it in this House formally. I want to say it again. It is so wrong that that fact hasn't been understood. It needs to be. It needs to be. And ads like this, after what happened, should not be allowed on the entrance doors to banks.
Thank you, Deputy Mathews.
Because it's... Hold on. The banks are selling the loans